Are carbon markets safe as politicking ramps up in the US? Luke Oliver is head of climate investments at Kraneshares. Luke, welcome back to Kitco.
Thank you. Thanks for having me on.
Firstly, Luke, what are you focused on?
Well, focused on energy transition. It's underway. It's happening. It's not a discussion anymore. This is well underway. Inflation Reduction Act, pricing carbon, everything is lined up. And not to jump on every weather phenomenon, but we're seeing the fires, we're seeing the heat waves, we're seeing wildlife washing up dead on the beach. We're just beyond that part of the discussion, and now we're onto solutions. And so, looking at anything carbon markets, energy transition, mining, as I know you're very close to, and of course, the key metals, which are also very key. The lithiums and the cobalts, and the copper that will be needed to go through that energy transition.
Take us through the portfolio at Kraneshares, Luke. It's mostly focused on carbon markets, correct?
Well, it is. Well, Kraneshares, as an asset manager, we actually focused historically on the Asian markets, and one of the leading China investors globally, offering some of the largest, most liquid ETFs. But the last 2 or 3 years, and partly, me coming on board here at Kraneshares was to develop this climate suite. And what climate suite means to us is not ESG, nice investments, social investments. This is just investments, and it's just investments in the biggest macro trend we're going to experience. So in the same way that the rise of China was an unmistakable trend that we've monitored very closely, we know that this climate transition is coming and is happening, biggest capital cycle we will ever experience. And so our portfolio looks like carbon. So of the billion or so dollars that we invest in these climate strategies, about 800 of that is in carbon markets. That's compliance carbon mainly, so government-run programs in the big four, which is Europe, UK, RGGI, which is the northeast of the US, as well as California, obviously the fifth biggest economy in the world. That is not, one state doesn't sound like a lot, but when it's the fifth largest economy in the world, it's very meaningful. And then also we are looking at the equities that are going to be big performers in this period. So we look at like EVs, we look at green tech, but we also like transition names. And by transition names, we mean some of the old legacy industrial names that are, branded as value stocks, as old industrial legacy stocks that actually are starting to look like growth stocks. So we're very interested in that. And then thirdly, as I mentioned, we like the metals. So if you think the carbon markets are going to be successful, we do. That's going to drive companies into decarbonizing, which they will. And then that will lead to a massive increase in demand that will really imbalance the supply and demand of those key metals. So copper on one hand, where we need to rebuild grids, electrify everything, and then lithium and cobalt on the other end of the spectrum, where we're going to need battery storage and solar panels and so on, and everything in between, zinc, nickel, aluminum are going to be big players. So we really have this three-strand strategy: carbon, equities, and metals.
Let's focus on the carbon markets first, Luke. What are they? How did they arise?
Yeah, well, that's our primary focus. So compliance carbon and voluntary carbon, two very different markets. Voluntary carbon is what a lot of you hear about, which is people growing natural forests or preserving forests or creating carbon capture technology and then selling offsets. So these projects are doing something that is carbon negative, i.e. it's capturing carbon, not polluting carbon, and they sell those credits to other companies. That's a new market, lots of opportunity, but that's a very much a frontier market. We only manage about $2.5 million, believe it or not, in that space. New market, somewhere where we're expanding into, but very new. The entire market is about $3 billion. Where our main drive is compliance carbon. And what that means, this is where actual government programs, essentially think of a dynamic tax. They have created a permit system where companies that pollute need to buy permits. They don't have to stop polluting. There's no overreach here. Simply, if you are polluting and causing damage to the environment, you have to buy a carbon permit to do that. And in doing that, that pricing suddenly kicks in capitalism. So this is often people say to me, "Oh, this sounds like tax. This sounds like socialism." It's pure capitalism. And before anyone says, "Well, it's got a tax element," true. we launch ETFs on the New York Stock Exchange. I can tell you that the US stock market is one of the most highly regulated markets in the world. So even the purest capitalism is full of rules and regulation, and that's all carbon is. Carbon pricing compliance carbon is where governments are saying, we are going to issue permits. They must be bought. They can be traded. They can be hedged. They can be speculated with. And by doing so, we create price discovery for the value of that ton of pollution. And what that does is create three incredible impacts. And the first impact is it creates revenue for those governments to then plow back into fighting climate initiatives or funding research into decarbonizing. Secondly, it creates fuel switching. So imagine you're a coal burning power plant. You burn coal because it's cheap. Natural gas is a bit more expensive. Solar and wind and geothermal is even more expensive. So you burn coal. Now the price on carbon, you start to be a bit more critical. Maybe coal isn't so expensive when you adjust for all the permits that you need to buy. So maybe you'll switch to gas. Maybe you'll switch to renewable energy. And by doing that, you're using natural capital markets to create a shift towards green technology and green energy. And then the third impact is that you've actually now put a value on that green energy. So new inventions are now economically viable. And so what we're seeing is even the energy companies love this, that there's this price on carbon, because they are some of the leaders. I mean, my favorite tiny anecdote is that most big oil and gas companies don't call themselves oil and gas companies. They call themselves energy companies now, because they're agnostic on where that energy comes from. They just want to provide energy to the global economy or to the local economy. So that means that they have the technology to go renewable. It just hasn't been economical. And these two incredible forces are at play now. Price of carbon is making it more economical to use the green technology and incentivizing the investment in it. And then things like the Inflation Reduction Act in the US, but there's a Chinese equivalent, there's a European equivalent, is actually giving waivers and incentives for companies to also accelerate their journey to decarbonizing. So we really are here at the beginning of this massive transition that we're going to go through. And I always say this, or I've been saying it recently, renewable energy. I hear so many people saying, oh, that's a new age thing. This is woke. It's not. We shouldn't be burning coal like we were 200 years ago. We're way past that. Renewable just means infinite. It means we can keep doing it at scale and cheaper and cheaper. That is human progress. And so we got behind our evolution here. We were progressing very well for a couple of hundred years, and then we really slowed down on the energy front. And so this is the kick in the butt, if you like, to accelerate this innovation again and get back to doing what humans do well, which is engineering and innovating. So that's what's happening, and that's what we're investing in, and that's why these carbon markets exist.
Luke, ESG has certainly come up on the political front. I want to get to that in a moment, but just to frame this a little bit more, what, as far as the compliance markets go for carbon, what countries are covered, and how do you see this growing out right now globally? Yes, well,
a couple of years ago, there was less than 20% of global emissions covered. Now it's about 26%. Some people will argue that 40% are covered by some form of these programs. So it's growing dramatically. The big four are the European Union, California, northeast of the US, and the UK. So they are the biggest, most mature, and they have a liquid futures market, which allows people to speculate, hedge. That's where you're getting the price discovery. Beyond that, there's also a lot of interesting markets like Australia, like New Zealand, that has a very comprehensive program. In fact, South Korea, China has announced that it's now out of its pilot phase and into the real carbon market. They're focused on this also, and we'll see versions of this. South America, there is more and more of the globe is being taken over by some form of carbon pricing. Think of them a bit like currencies. They're not one market. There's not one price of carbon. Each country has its own scheme. That's okay. Doesn't need to be the same price everywhere. What counts is that each country is using a carbon price to internalize that cost of pollution. And by doing so, they're going to accelerate decarbonization. But why this is so important is so many people think that this is make the country less competitive. And again, it's the opposite of that. There is an arms race for every major economy, whether I think of China, US, Europe as kind of the big three, all racing to own the IP, and own the natural resources that will allow them to decarbonize. And whoever gets there first will export that technology to the others. So we really are in this great moment of opportunity, and carbon pricing is just one major part of that.
Luke, you're talking with Kitco, and we're focused on precious metals. And if you want exposure to precious metals, you can buy a gold bar, you can buy a senior gold miner, you can buy a royalty company. And then if you really want to, how would you say, increase your risk or increase your, your possibility for a payout, that would be investing in a junior. Can you roughly talk about buckets that you could invest in energy transition, and maybe compare that against how it would be looking at the carbon markets?
Yeah, and if I understand the question, I think looking at compliance carbon is not that unlike the mindset is not that different to thinking about gold, in that this is like a commodity, but it's not a commodity like oil or soybeans or lean hogs, where there are harvests and decay of the material and shipping and expensive storage costs. This is essentially like a financial asset in the same way that gold is. It's a physical. There's a carbon allowance and there's a bar of gold, but the way that is stored relatively cheaply per kind of unit size, and the fact that the futures curve is relatively flat, means that it is more like a store of value, with a view that, in the same way that you might think that gold has this risk off property, when markets are shaky, gold goes up and it kind of acts like a hedge. The way we think about carbon is a little different. We think about carbon as being in one mega, the word mega gets used way too much, but one mega cycle. The global governments are tightening the carbon markets between now and 2050 to bring about higher carbon prices that will incentivize all this decarbonization that I'm talking about. So it probably has a 30-year shelf life, not an infinite shelf life like gold has, but at the same time actually has a positive expected return. I'd argue gold does not. Gold values will be kind of move around with risk. Supply and demand for gold doesn't really fundamentally change apart from that kind of risk element. Whereas carbon, we're expecting demand to slow, because that's what reducing pollution means. But we think the supply will be tightened by the so-called central banks of carbon. The California Air Resource Board, the European Commission, will tighten carbon faster than pollution drops in order to keep pressure up on decarbonizing. So you have a asset that kind of feels like a commodity, similar to gold, but actually has a very strong positive return and still has the low correlation that you get from commodities. And then, of course, I believe. Yeah, please.
Sorry, I apologize, Luke. I didn't necessarily want to ask you about investing. Comparing gold versus carbon market credits. I appreciate it, but it was more along the lines of there's so many options for investing in energy transition. I was just kind of wondering around, how does investing in the carbon regulatory market, say, compared to, say, just buying an index of companies that are focused on energy transition, for instance.
I get it.
And then also as well too, you could also, I think there's also some options where you can buy, you can physically hold uranium or physically hold cobalt, for instance. So what are those buckets, and how would the carbon regulatory markets compare?
Yeah, no, absolutely get the question now, and we think about. I think you're hitting it exactly what the answer is that you could play some of these things with stocks or country allocations, but some countries will be winners, some countries will be losers. Some stocks will be winners, some will be losers. What I believe will win, and more reliably win, is the price of carbon, because the countries are all engineering a tighter carbon market in order for their stocks to win. So you can bet on the stocks, but there'll be winners and losers. But if you use the don't fight the Fed mentality, don't fight the price of carbon, it is being engineered to move higher over time. So that, to me, is a much more reliable way to play this. And it's a purer way to play it. If you think there will be tighter climate action, why not be long the climate action, which is the carbon market? Whereas when you play with the stocks, you're saying, I think this company will be successful in the carbon transition. I'd rather be long the price of carbon. Second, and in following that through, I'd also like to be long, as you said, cobalt, lithium, copper, because different companies and countries will all try to secure their own supply lines. They will all try to increase their own ability to mine locally all of these metals, or have, like I mentioned, get the supply chains. They'll all fight for these supply chains, and some will win, some will lose. But what will win will be that there'll be this massive demand. Whether it's from the winners or the losers, they're going to demand more of these metals. And so more reliably, I think that the supply of these metals will struggle to keep up with demand. And that's why I like the physical commodities, or when I say physical, the actual commodity versus the miners or the stocks. And the price of carbon, to me, the price of carbon is a new asset class. It wasn't an option before. It is now. Our ETF has made this highly investable, highly liquid, and available anywhere you buy equities to allow you to add this. So I think people need to really consider adding carbon as a new asset class. And I do think they should play the commodities themselves rather than the miners and the companies. I don't know if that agrees with Kitco's view, but that's certainly how we see it.
Luke, how have carbon markets performed right now? So we've been carefully following what copper's been doing, and copper's been an interesting metal because it certainly has a role in energy transition, and they look to declining grades that are happening at mines. But at the same time, it's also a macro metal, Dr. Copper, and just what has been happening in China. Outside of the US, what has been happening in the European Union, you've actually seen it's been disappointing, and it's actually been trading lower as well too. There's still the copper bulls out there, though, that believe in energy transition, look at how much copper is actually going to be demanded. Is much of those themes reflected within the carbon markets, Luke, or are we seeing something different? Similar.
And the copper is interesting because as people get more worried about the economy, copper is often a kind of canary in the coal mine if people are building less and consuming less, they're using less copper. But I do think this tailwind from this massive upgrade of the global electrical systems is going to really shift copper. And it's surprising to me that that's not being priced in already. So I think there's opportunity in copper, but you're right. But carbon is exactly the same. Just a trade I've been looking at recently is how, natural gas prices affect the price of carbon. When the price of natural gas is rising, often the price of carbon will rise because as it gets more expensive to go green or greener from coal to gas, you start backsliding to polluting more. So the price of carbon can increase. But when if we go back to, the months after the invasion of Ukraine, we saw natural gas prices get incredibly elevated to the extent that a lot of industries in Europe stopped operating. Things like fertilizer and metal production that used a lot of energy actually ceased operation. So then pollution dropped. So you had this kind of strange dynamic that I don't know that the market has figured out yet. And it's something I watch very closely. And I think there's a lot of opportunity in the carbon markets because there are these strange correlations that are positive up to a point and then flip negative up to another point. So using my nat gas example, as it rises, it's got a positive correlation with carbon. If it rises too much, it becomes a negative correlation with carbon. And I think that is currently because there's coal gas switching. When all that coal gas switching is done, that correlation will shift to the next thing. And who knows, that could be gas and cobalt because we're moving from renewable energy away from gas and so on. So there's a lot of, if you're a trader in the carbon markets, there's an incredible amount of opportunity because we do see inefficiencies and we do see lags between moves in one market that affect carbon, where we can see, several days between, the foundations of a trade establishing themselves and the trade and the move happening. So definitely lots of opportunities there. But ultimately, we think you should be long carbon. You should be long those 4 compliance carbon. You could debate about the weights, but you've got to be long that market. You've got to have something in your portfolio because don't forget, every equity you hold is sort of short carbon. All of those stocks are going to have to pay the price of carbon somewhere or face regulation somewhere that's going to be expensive. The way to hedge that and protect against that is to be long carbon.
So how was the fund recently performed, Luke?
Yeah, well, so we've seen interesting performance. We've been a little bit sideways in Europe. European carbon is one of the more expensive markets. It's traded between 80 euros and 100 euros, and we've been inside that range. It's a 16% range, give or take, that we've seen it move in between. Now, we keep making higher lows and yet we never really materially get through 100 euros per ton of carbon. So that range is getting tighter and tighter and tighter towards 100. Basic technical analysis would suggest then you have the breakout, and the breakout based on flat at the top and sloping up below that would be a breakout to the upside. We look at forecasts from Bloomberg and others are seeing 160 euro carbon in Europe. So if we're at 90 euros give or take today, it's a pretty significant upside over the next few years up to that 160. Incredible, in fact, but we think maybe that one plays out sort of in sort of 20% increments, 30% increments over the next few years. And then California, on the other hand, is only really getting into its price discovery moment now. Why? Because the imbalance of demand and supply is only really starting to bite. So California carbon, just to go back, Europe has been tightening aggressively since about 2018. California has actually been growing its liquidity up until last year, and now that's rolling over. And as the cap comes down, the secondary market supply is really starting to move now. It's really starting to tighten up. So we think from here on out, California is going to perform very well. And so we've seen California do very well in a much less volatile pattern than it had previously. So we saw lots of sharp spikes up and down over the last few years. California now has just been slowly grinding up from about $28 a ton to about $34 a ton. And that's been great to see, because we've been calling for that March higher, but we just couldn't really put our finger on when we thought it would happen. And it seems to be happening now.
Now, we teased it out before, but talking about politics and with the upcoming presidential election, Governor Ron DeSantis is in the mix for on the Republican side. He's certainly been beating up, how would you say, social, political, and ideological interests regarding investment decisions about the state's pension fund. BlackRock had its own fund down in Texas, just regarding ESG investing. Are these carbon markets going to be safe as a Republican swing during the upcoming election, Luke?
Yeah. A couple of things. One is these markets survived, Donald Trump era unscathed. We had a slight bump in the road between Pennsylvania and Virginia. Virginia was potentially going to leave RGGI, which is the Northeast program, and Pennsylvania was going to join. And then you had a switch of governor and legislature and debate, and both of those are kind of on hold. So Virginia is still in, hasn't left. Pennsylvania hasn't joined, but may still join, and that will actually be huge. I mean, Pennsylvania will almost double the size of that program. So there is a political element. I'm going to say one thing that's not very controversial, which is 2022 was a heck of a year. We had invasion in Ukraine. We had energy crisis in Europe. And the European program came out stronger and tighter and optimistic. So any political risk we thought there was, if you had extreme circumstances, I think that's been put to bed. Europe came out of it stronger. And in the US, we had rampant inflation, and the California program came out stronger and more optimistic, and with tighter 20%. It went from 40% to 48% reduction in pollution targets. So I think political risk is actually quite low, because we've seen it tested incredibly in the year 2022, and in both major cases came out stronger. The controversial thing I'll say, or not, depending on your leaning, is, and I don't think I've ever said this before, but I totally agree with what Ron DeSantis says, is that you should, or to paraphrase, you should invest based on sound investment thesis. You should be a fiduciary. And that's correct. What I fundamentally disagree on is what that means. What that means is that you should invest in sound investment thesis and with risk and return in mind, and not necessarily concepts of social considerations necessarily. However, that is where the performance is going to come from. So I believe that some of the early ESG products were not well designed. They were very crudely built, filter for the highest ESG scores and buy those stocks. That threw out 50 years of investment or 100 years of investment fundamentals. What we should be doing is looking at things like ESG scores to see where opportunities are. Are there companies that are moving Can you use ESG scores to identify companies that are shifting from low margin, low growth businesses into high growth, high margin businesses? Because if you can see that through ESG and CapEx on renewable energy, that's an incredible investment thesis. So yes, I agree that we should all be fiduciaries, but I believe as fiduciaries, you absolutely need to look at ESG. And personally, I don't use ESG. Our strategies do not use ESG. We simply invest in the companies, commodities, and carbon markets that we think are going to perform very well. But by them performing very well, we will be decarbonizing the economy and creating great opportunities. So it's as always with all of these things, two things are true. Yes, you should be fiduciary, but also yes, you should be considering this massive energy transition we're going through, because you'd be crazy not to check your portfolio for risk or alpha opportunities through that process we're going to see over the next 10 years.
Lastly, Luke, I want to lean on you here and your 30,000 foot view. We have a lot of juniors that have pivoted to the voluntary carbon markets. I just wanted to get your own assessment of how that market looks in comparison with the regulatory carbon market. What's the opportunities you see there? How successful is that voluntary market going to be, and who are going to be the winners?
Yeah. Well, it's a tricky question. I'm very excited by this market. Mm-hmm. It has a lot of, I said it at the beginning, this is a frontier market, and there are going to be some big losers and some big winners. And the art will be, or the science will be picking those that are the winners. And it's tough because there's a lot of criticism has been aimed at some of the registries and some of the methodologies. Not all carbon offsets are created equal. Not all of them capture carbon the same way. Not all of them capture carbon for the same amount of time. Not all of them have, co-benefits. Something can capture carbon for 1,000 years. Something else can capture carbon for 100 years, but also creates jobs or, smooths out inequalities in particular regions. And so each has to be looked at maybe a little bit like a bond or like a stock. You need to look at each project and weigh up the holistic benefits and the holistic price and the holistic investment opportunity. Because remember, initially, these aren't designed to be investments. These are designed for companies to offset their carbon footprint. But in any valuable asset, you then have a need to hedge that asset, and then you have an investable market. So look for good quality. What does good quality mean? It means lots of different things. I think the rule of thumb here should be invest in projects that are bulletproof from a journalist writing an article saying that this thing is garbage. So, the example being some existing forests that sold offsets, that seemed like a good idea. You're protecting a forest. And recently there was this big article in The Guardian that talked about the fact that those forests weren't in danger, so paying to save them was a waste of money. And there's certainly some truth to that. You also don't want to throw out the baby with the bathwater. It's incredibly important we do protect existing forests. So it's difficult, it's challenging. Rely on people in the know. I'd like to think I'm one of those people. Talk to people in the industry. And when you are getting into this market, this is a frontier market. It's not something you buy in India. You don't buy the S&P 500 of carbon allowances. You need to be very knowledgeable and very careful. But there are great opportunities out there, and I look forward to having a lot of fun and success in these voluntary carbon markets.
Luke, I think you gave me an assignment.
Yes, let's keep talking.
Luke, always a pleasure. Always very informative. Thanks for being a friend of Kitco.
Thanks so much. Talk to you soon.
My name is Michael McRae, and you're watching Kitco Mining.